This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Welcome back to the IUX podcast, a part of Trade Alive, brought to you by IUX Education and IUX Trading Platform. We help you explore the lives, lessons, and legacies of the world's greatest traders. Let's start today with a little thought experiment. Imagine you decide to open a high-end restaurant in the middle of a busy city. You hire the best chefs, you perfect your menu, and you buy the freshest ingredients. You are entirely focused on the food. But at the end of the month, despite having a line of customers out the door, your bank account is empty. Why? Because you completely ignored your overhead. You forgot to calculate the rent, the electricity, the taxes, and the payroll. The operational costs quietly ate your business up from the inside out. In the financial markets, participating in the exchange of assets comes with the exact same reality: unavoidable operational costs. But here is the problem. The vast majority of retail traders treat the market like a video game. They focus entirely on market direction. They spend hours drawing trend lines, memorizing chart patterns, and analyzing macroeconomic data. But they overlook the rent. They overlook how transactional fees quietly, silently erode their capital over time. Brokers are not charities. They provide you with the trading platform, the real-time data feeds, the liquidity, and the market access. In return, their primary revenue streams are generated through two main mechanisms: spreads and commissions. Understanding these costs is not merely an administrative task. It is a critical, fundamental component of risk management and strategy formulation. The harsh reality is that your trading strategy must generate enough gross profit to overcome these combined frictional costs before you realize any true net gain. If you make a $100 profit on a trade, but it costs you $15 in hidden fees to enter and exit, you didn't make $100. You made $85. And if you take 10 trades a day, that $15 fee suddenly becomes a $150 daily anchor, dragging down your portfolio. The impact of these fees is heavily dependent on your specific trading style. A high-frequency scalper will feel the crushing weight of these costs much differently than a long-term position trader. To optimize your operational efficiency and ferociously protect your profit margins, you must deeply understand the mechanics of these fees. Today, we are going to expose the hidden mechanics of your broker. We are going to break down the exact difference between a spread and a commission, how they are applied, and how they behave across different chaotic market conditions. To truly master your trading overhead, you must understand the fundamental difference between a spread and a commission. While both serve as broker compensation, their mechanics, their transparency, and their impact on your strategy are entirely distinct. Let's tear them apart, starting with the most misunderstood fee in the industry. The spread is the most common, yet often overlooked, cost of trading. It acts as an implicit or hidden fee. It is not listed as a line item charge on your receipt. It is baked right into the price of the asset. Think about the last time you traveled to a foreign country and went to a currency exchange booth at the airport. You look at the glowing board. It says they will buy your US dollars for 0.90 euros, but they will sell you US dollars for 0.95 euros. That gap, that 0.05 difference, is the spread. The airport takes a cut of the transaction simply by giving you a slightly worse price than the actual raw market value. Your trading broker does the exact same thing. The spread is defined as the gap between the bid, the sell price, and the ask, the buy price, of an asset. When you click buy,
you pay the slightly higher ask price. When you click sell, you receive the lower bid price. Because of this gap, the very second your order is executed, your trade instantly shows a minor loss. You start in the red. The price of the asset must move favorably, past that spread distance, just for you to break even. But here is the absolute most dangerous part about the spread. It is dynamic. Spreads are heavily reliant on market liquidity and volatility. In highly liquid markets during peak hours, like trading the EUR/USD when both London and New York are open, spreads are typically very tight. However, during periods of low liquidity, like late at night, or during major economic news releases like the non-farm payrolls, the big institutions pull their orders. When the liquidity vanishes, the broker widens the spread drastically to protect themselves. A spread that normally costs you $2 could suddenly widen and cost you $20 just to enter the trade. This dynamic nature means the exact cost of entering a trade via spread can be wildly unpredictable during volatile conditions. Now, let's look at the other side of the coin. The commission, the explicit, transparent cost. A commission is an explicit, transparent fee charged by the broker for executing the transaction. Unlike the fluctuating hidden spread, a commission is not built into the asset's price. It is deducted separately, directly from your account balance. Think of a commission like a flat delivery fee on a food app. It doesn't matter if you order a $10 burger or a $100 steak. The delivery fee might be a flat $3. Commissions are highly predictable. They are typically calculated as a flat rate or a small percentage based on your trading volume. For example, a broker might charge you exactly $3 to open one standard lot and $3 to close it. Total cost? $6. Because it is a known static variable, you, the trader, can precisely calculate your overhead before ever entering a position. There are no surprises. So, the core difference and strategy alignment. Which one is better? The ultimate difference between spread and commission dictates which account structure suits your specific methodology. Brokers typically offer two types of accounts. Let's look at two different traders. Trader A is a swing trader. He looks for massive 200 pip moves that take days or weeks to unfold. Trader A should use a standard account, spread-based. Brokers offer these accounts with zero commissions, but mark up the spread to cover their costs. Because Trader A is aiming for a massive 200 pip target, paying a slightly wider 2-pip spread doesn't matter to him. It has a minimal percentage impact on his overall profit. He doesn't want to pay a fixed ticket fee every time he enters a trade, so he absorbs the slightly wider price.
Trader B is a high-frequency scalper. She trades on the 1-minute chart. She looks to make quick 5-pip scalps, executing 20 trades a day. Trader B must use a raw ECN account, commission-based. In this account, the broker provides the raw institutional market spread, which is often at or near zero. The bid and the ask price are virtually identical. But in exchange for this perfect pricing, the broker charges a fixed commission per trade. Because Trader B is aiming for tiny 5-pip targets, every single fraction of a pip matters. If she used a spread-based account, the spread would eat 50% of her profit on every trade. Tight spreads are absolutely necessary for her precise entries and exits, making a predictable, fixed commission mathematically superior for her strategy.
Let's bring this all together. In conclusion, the operational cost of doing business in the financial markets cannot be avoided, but it absolutely can be strategically managed to protect your profit margins. The ultimate difference between a spread and a commission in trading lies in transparency and application. You must decide whether you want to pay an implicit dynamic cost embedded within the asset's price through the bid-ask gap, or an explicit, highly predictable transactional charge deducted separately from your balance. There is no universally best fee structure. Anyone who tells you otherwise doesn't understand market mechanics. The right choice is dictated entirely by your trading style. You must evaluate your own strategy. Ask yourself, am I prioritizing standard, zero-commission accounts with wider, fluctuating spreads because I am a swing trader holding positions for days? Or do I require raw, zero-spread pricing with fixed commissions because I am a day trader or scalper who demands absolute precision on the 1-minute chart? By carefully aligning your broker's fee structure with your specific trading methodology, you ensure that these frictional transactional costs do not unnecessarily erode your account. You stop the bleeding. Treat your trading like a business. Manage your overhead. By doing so, you maintain a clear, unclouded focus on your ultimate objective: capital preservation and steady mathematical growth. As we draw today's episode to a close, I want you to take a moment and reflect on your own routine in the markets. Based on what we just discussed, which camp do you currently fall into? Are you more like Trader A, swinging for larger targets with a spread-based account? Or are you like Trader B, scalping the minute charts and relying on fixed commissions? Drop a comment below and let me know your trading style and which fee structure you prefer. I'd love to read through your answers and see how you are applying these concepts to your own trading business. Thank you for tuning in to this masterclass on market mechanics. If this episode helped you understand where your capital is actually going, hit the like button, subscribe, and share this with a fellow trader who might be using the wrong account type for their strategy. Thank you for listening. See you in the next episode. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.